Have you ever done this thing where you finally get a better paycheck and you still don't feel safe? I used to think if I could just hit about 5 grand a month, I'd be set. Like, okay, I made it. But then rent goes up, food gets pricier, you upgrade one thing, then another, and somehow you're working just as hard, but the finish line keeps moving. And the worst part is you start looking around. Friends buying homes, people traveling, TikToks of easy money. And you start thinking, am I behind or is the whole game rigged? Here's the misconception most of us get taught. Work hard, save what you can, and your retirement plan will take care of you. Sounds fair? Sounds simple. But what if the simple path most people follow is the exact reason they end up stressed later? What if the real problem isn't that you don't work hard, but that your money doesn't work hard with you? I'm Mark, and this is Dividend Hustle. Today, I'm going to walk you through a 2 ETF setup that's built around one idea. One ETF is meant to grow into a big pile over time, and the other is meant to grow into a real income stream. And I'm going to do it using the same kind of daily habit most people can actually stick to, like $10 a day. No fancy trading, no guessing games, just a plan that's easy to follow. Now, I'm not promising anything. Markets move, nothing is guaranteed. This is for education, so you can think clearly and make your own choices. But I will show you the logic, the numbers people miss, and the reason this boring approach has helped regular people build serious results over time. And in a few minutes, I'll reveal the 2 ETFs and why they were picked. Because the twist here is not find the next hot stock. The twist is that simple beats smart when you do it long enough. Let's do a quick reality check. Not to make you feel bad, just to get clear. Right now, the average full-time worker in the US earns about $62,000 a year. That's around $5,000 a month before taxes. On paper, that sounds fine. You can pay bills, you can live. Maybe you even save a little. But think about what you trade for that number. You give around 40 hours every week. You do it for years, decades. And if you do what you're told, work hard, be responsible, and steadily put money into a 401k, what do many people end up with near retirement? Around $244,000 on average for ages 55 to 64. After a lifetime of effort, that's the finish line for a lot of people. And I'm not saying $244,000 is nothing. It's something. But for many people, it still feels tight. It often doesn't replace a full-time income. It doesn't always buy true freedom. That's why we're having this talk. And in a few minutes, I'll show you the exact 2 ETFs I'm talking about and why one is built for income and the other is built for wealth. Now here's the big myth that keeps people stuck. The myth is more moves equals more money. More accounts, more picks, more strategies, more watching the market, more switching things around. It sounds smart, but it usually does the opposite. Let me tell you a quick story. My friend Mike and I used to do this thing where we'd check the market like it was a scoreboard. If something went up, we felt like geniuses. If something went down, we felt like we were behind. And then we'd start fixing it. We'd switch funds, we'd chase what was hot, we'd overthink every headline. And you know what happened? We got tired, we got confused, and we made small emotional mistakes that added up over time. That's the truth most people don't want to hear. Complexity usually hurts results. Not because you're dumb, but because humans are emotional. The key idea is simple. Consistency beats cleverness. The real win isn't picking the perfect thing once. It's sticking to a strong plan long enough for it to work. So the question becomes, how do we pick just 2 ETFs out of thousands and feel confident about it? Good news, I'll show you the filter I use next. Here's the filter I use, and it's simple on purpose, because simple is easier to follow when life gets busy. Step 1, I want a fund with a strong track record. Not perfect every year, just solid over time, through good markets and bad markets. Step 2, it must pay dividends, because dividends are real cash paid out to investors. But I do not chase crazy high dividends. A super high yield can be a warning sign. Step 3, I want dividend growth. Getting paid is nice. Getting paid more every year is better. Step 4, I want share price growth too, because you don't just want income, you also want the value of your investment to rise over time. And step 5, I check the companies inside the fund. Are they real businesses with real profits? Do they sell things people keep buying even when times are hard? When a fund passes all 5 tests, it usually isn't exciting. It won't make headlines, it's not a wow story at parties, but it does more important. It works. And next, I'm going to reveal the first ETF in this plan, the income engine, and then we'll run the simple $10 a day math. So let's start with the income side. This ETF is called SCHD, which stands for Schwab U.S. Dividend Equity ETF. In plain words, it's a basket of strong U.S. companies that pay dividends. You buy one ETF and you own a mix of many businesses at once. That helps you stay diversified, which is just a simple way of saying you're not betting everything on one company. Now, SCHD isn't famous because it's flashy. It's respected because it's been steady. In the most recent 12 months, it returned about 1.9%. Over the past 5 years, it gained about 47.66%. Over 10 years, it gained about 100.25%. And while it grows, it also pays you. Its dividend yield is about 3.97%. Even better, its dividends have grown over time. The 10-year dividend growth rate is around 11.3% per year. It also has an average annual share price growth of about 7.02%. And it does all this with very low fees. The expense ratio is about 0.006%, which means it keeps more of your money working for you. Now let's talk about what's inside it, because that matters. SCHD holds a lot of well-known, profitable companies. You'll see names like Coca-Cola, Verizon, Altria, Lockheed Martin, Cisco, ConocoPhillips, and Home Depot. These aren't lottery ticket companies. They're big businesses that have been around, that make real money, and that tend to share part of that money with investors. The fund also leans towards sectors people still use even when the economy is shaky. It has a big slice in consumer defensive at about 19.58%, energy at about 18.98%, and healthcare at about 14.44%. It also includes industrials and tech at around 11% each, plus smaller parts in other areas to stay balanced. The point is simple. SCHD is built to be steady, to pay you, and to grow those payments over time. Now the fun part is next, because once Mike saw what SCHD is and why it's built the way it is, he asked the same question you're probably thinking right now. Okay, Mark, but what does this look like if I invest just $10 a day and I reinvest the dividends? That's where the snowball starts. And in the next part, I'll show you exactly how that snowball can grow year by year. Mike looked at me and said, okay, I get it. SCHD is steady, it pays, but show me what happens if I actually do the boring part every day. So we ran one simple habit, $10 a day. That's it. No big lump sum, just consistency. Over 1 year, that adds up to $3,650. Nothing crazy, but it's a seed. Now, here's where it starts to feel different. If you keep doing that and you reinvest every dividend instead of spending it, the numbers start to stack. By around year 10, this example timeline shows roughly $65,000. By year 20, it shows about $320,000. And by year 30, it shows around $1.79 million. Now, pause right there, because this is the part people misunderstand. That result is not just from the market going up. A huge part of the growth comes from the dividends being put back in again and again, like rolling a snowball downhill. In this example, by year 30, the dividend income reaches about $199,000 a year, which is about $17,000 a month. Again, that's not a promise. It's an illustration based on the same historical style averages and reinvestment behavior used in this breakdown. Real-life returns change, dividend payouts change, prices change, but the lesson stays the same. Reinvesting turns small cash payments into a compounding engine. And here's the breakdown that really hit Mike. Out of that total, about $664,000 is from price growth, but about $1.27 million is from reinvested dividends. So more than half of the outcome isn't from guessing the market. It's from owning something that pays you and then letting those payments buy more shares. Mike just stared at the numbers and said, so the money is making more money, and the money it makes keeps making more money. And I said, exactly.
But here's the curiosity twist. That's only the income side of the plan. SCHD is built to pay you and grow that payment. But what if you also want a second engine that focuses less on dividends today and more on building a big pile faster? Because the next ETF is the growth rocket. This one is called QQQ, the Invesco QQQ ETF. In plain words, it holds big companies on the NASDAQ. These are the builders of the future, the companies behind the tools you use every day. Phones, cloud services, chips, online shopping, AI, things that keep growing because the world keeps using more tech. And the past performance numbers used in this breakdown show why people call it a rocket. Over about 1 year, it's up 15.47%. Over 5 years, it's up 122.05%. Over 10 years, it's up 381.11%. Those are huge moves, and they come with a trade-off. This fund can swing up and down more than a calm dividend fund. That's the price of growth. Now, the dividend on QQQ is small. The yield in this breakdown is about 0.58%. That's because most of these companies don't focus on paying big dividends. They focus on growing fast. Still, the dividend has grown over time in this example, around 10.3% a year over 10 years. But let's be honest, QQQ is not the Pay Me Now fund. It's the Build It Big fund. The big driver is share price growth. In this breakdown, the average annual share price growth is about 16.78%. That's the compounding fuel. And the expense ratio used in this example is 0.2% in this example set of numbers. But always check the latest fund facts, because fees can change and sources can report them differently. What's inside QQQ is also the reason it moves the way it does. You'll see names like Microsoft, Nvidia, Apple, Amazon, and Broadcom near the top. These are giants, and when giants grow, the whole fund can grow fast. But when tech gets hit, the whole fund can feel it too. So now the real question is the one Mike asked next. Okay, Mark, if SCHD can turn $10 a day into a growing paycheck, what happens if we run the same habit through QQQ? That's what we're doing next. So we ran the same habit through QQQ. Same rule. $10 a day, that's $3,650 after 1 year. Now watch how the growth engine behaves in this example timeline. By about year 10, the portfolio grows to around $82,000. By year 20, it reaches about $478,000. And by year 30, it climbs to around $2.36 million. Again, this is not a promise. It's a simple example based on the same kind of past results used in this breakdown. With dividends reinvested, real returns can be better or worse. But the lesson is clear. QQQ is built to grow the pile. Now let's talk about the income from QQQ, because this part surprises people. By year 30, the dividend income in this example is about $1,700 per year, which is about $150 a month. That's not the point of QQQ. This is why I tell Mike, and I'm telling you, QQQ is not the cash cow. It's the compounding machine. In this example, out of the total, about $2.23 million comes from growth, and only about $17,000 comes from reinvested dividends. That's QQQ's job. It's there to scale your money, not pay you big checks today. And this is where the 2 ETF idea finally clicks. Your job pays you when you show up. If you don't show up, the pay stops. But assets pay you when you hold them. You don't have to clock in for a dividend to hit your account. You don't have to ask a boss for permission for your portfolio to grow. That's the whole point of building both sides. SCHD is the part that aims to create cash flow and grow that cash flow over time. QQQ is the part that aims to create scale through long-term growth. One helps build the paycheck, the other helps build the pile. And when you compare it back to the normal path, you can see why this feels so different. The average full-time worker earns around $62,000 a year, or about $5,000 a month. And the average 401k balance for ages 55 to 64 is around $244,000. That's why so many people feel stuck. They work hard for decades, but the ending still feels small. This 2 ETF plan is built around a different idea. Keep it simple, stay consistent, and let time do the heavy lifting. And next, I'll tie both ETFs together into one clean plan so you can see how the whole picture works. Before we wrap up, let me say this clearly. No promises. Markets move, dividends can change, prices can drop. This video is education so you can understand a simple framework and make your own decisions with clear eyes. But if you take one thing from today, let it be this. You don't need to be brilliant to build wealth. You need to be consistent. So here are the simple steps. Start small, something like $10 a day if that's what you can do. Keep it easy, make it automatic, then reinvest dividends, especially in the early years so the snowball can grow. And most important, stay consistent, even when the market is boring, even when it's scary, even when you don't feel like it. That's where most people lose, not because they picked the wrong thing, but because they quit too early. Now, I want to hear from you. Comment this. Are you more focused on income or growth right now, and why? I read the comments, and it helps me make videos that match where you are in your journey. And in the next video, I'll show you something super practical. How much you'd need in SCHD to retire in 30, 20, or even 10 years using simple math and clear steps. This is Mark from Dividend Hustle. Thanks for watching, and I'll see you in the next one.